Started. Okay. So I'm going to get started, and people, as they come in, they can ask questions. But I am Brett Hertz with Prime Lending. I work on Artin Babayan's team. A few of you might have met him before or seen him around or done deals with him. So our office is right down the street from the Sherman Oaks Keller Williams office. And so we will be, providing these informational, educational seminars every month or whenever you guys require them with your teams. Also, myself and a couple of the other lenders on our team will be in your office a few days a week on Mondays, Wednesdays, and Fridays for about 4 hours each day. So at the end of this, I can provide everyone's contact information if you want to contact us directly or have any specific questions about anything we talk about here. So I just want to get started by asking, seeing if anyone has any questions or any kind of scenarios that they're running into that they kind of want some more information from a lending perspective. Okay, so no questions now. So question Rouse had earlier was what the approximate interest rate is now. So right now that kind of varies depending upon the credit score, how much money people are putting down, and the loan product. So right now you can expect rates in the mid to low threes, and then with jumbo rates being right around 3 and FHA rates being slightly lower, even though those loans are a little bit more expensive. I can get into a few of the specifics about the different kind of loan programs we have and what you can expect your borrowers to get into. So I'll just jump right into that. So right now, the conventional loans, which are typically done through Fannie Mae and Freddie Mac, borrowers can put down as little as 3%. But obviously the less you put down, the more expensive the rate is, and what's called the mortgage insurance. So mortgage insurance is, it's an additional coverage for the bank or lender to provide them some protection because the borrower is putting less money down. So that's an additional fee each month until the borrower either gets up to about 20% equity, or within, after 6 months of funding the loan, they can request to have an appraisal done at their expense to show that they have gained additional equity in the property. Typically, with those, we want to see a minimum credit score of about 620. And ideally for a strong borrower, 5% down is great because the mortgage insurance is so low and money is so cheap right now. It's a great opportunity for them to get a large loan with minimal down payment, so they have extra funds to fix up the property, pay for whatever else or any other debt that they may have. So those conforming limits right now in non-high cost areas are $548,250. So that's the loan amount. We can structure deals in areas like that for, let's say, like a purchase of 600 grand, where they would have to come up with 52 grand down. That's just the max loan amount. It's not the max purchase price. And then in higher cost of living areas like Los Angeles, those conforming limits go up to $822,375. So for conforming loans, it's a more streamlined process for the borrower. It's a more set of rules. It's a little bit easier to push through underwriting and get approved. This is going to be the majority of our borrowers in this range, with typically debt ratios of under 50%. So a debt ratio means the debt to income, where all liabilities that they pay, whether it's student loans, credit cards, lease and car payments, any other debt like that, including the new estimated mortgage payment, we want to keep that under 50% of their gross monthly income. So not their net, what they, their gross is before taxes. Other types of loans include like an FHA, which some of you may have had borrowers use. This is also a program typically for borrowers that don't have strong credit. You can go up to, or a minimum 3.5% down on these programs. They're a little tricky because it sounds great because the rates are typically lower, but this is a more expensive loan for borrowers. With this, especially with the lower down payment, there's an upfront mortgage insurance premium cost on the loan of 1.75%. So in an example, it's a $500,000 purchase with 3.5% down. The loan would be, 482,000, right around there. But with the additional mortgage insurance premium costs of about $8,000, that loan jumps up to 490. So it feels like less money down, but at the end of the day, it's added onto the loan balance. So it actually tends to be a little bit more expensive. And also the mortgage insurance premiums monthly, the insurance that the borrower must pay because they have less than 20% down is more expensive with these types of loans. So even with the lower interest rate, it's a higher cost on a monthly expense to the borrower. And also with those, keep in mind, it gets you across the finish line. It gets you to be able to purchase if your credit isn't so great, or if you don't have much money to put down. But the monthly mortgage insurance premiums do not go away with this. So if you do under 20%, you can expect to pay that monthly insurance cost for the life of the loan, or until we refinance. I want to stop and see if there's any questions so far, or any kind of specific scenarios that you guys have run into, if you have any questions. All right, so no questions so far. I'm going to touch on a couple of terms you guys may have heard, the desktop underwriter, DU, or LPA. So these are things that lenders use when using conventional loans through Fannie Mae and Freddie Mac. So the DU is basically, we gather all the documents from the lender, or from the borrower, which include, on the basics, driver's license, 2 months of bank statements, the quarterly retirement assets if necessary, 2 years of tax returns, 2 years of W-2s, and we go from there. And then we can input all of the information along with their most recent month's pay stubs to confirm their income. But once we have that, we can use that income plus their assets for down payment to come up with, put it into the system. It gives us an output of, accept or decline. So from there, we can start the whole process of the pre-approval and kind of work backwards from there to find a property. With this, you've also seen appraisals get waived in certain areas. So this is all dependent upon which loan program we choose and how many recent sales there have been in that area. So let's say in Sherman Oaks, if there have been 100 similar sales in the $800,000 region, we may be able to get another similar sale appraisal waived if the borrower is strong enough and if that loan program has enough information to go off of without an updated appraisal. Are there any questions on desktop underwriter or getting appraisals waived or anything similar to that? Okay. So I want to talk about strengthening your offer with loans that are under jumbo. So we've run into the situation a lot recently where people are either getting turned down from checking out properties or an offer is not being accepted because of a lower down payment. And the way we can work with that is to actually come up with a scenario and talk through it with your lender, whoever you choose to work with, to see what the strongest foot forward is to put. So a lot of times right now with well-qualified borrowers, the money is so cheap that it makes more sense to put less money down and get a larger loan. But sometimes the listing agent doesn't always see it that way. So that's where we can step in and actually talk up the assets or talk to the listing agent directly to show them that that the borrower or buyer more down payment. And then once the offer is accepted, work with the listing agent to come up with an addendum to adjust the loan balance. That's also something that happens a lot recently. Whether the borrower's credit score has increased and they have more opportunity to take on more debt, or the appraisal comes in a little low. You need to put less down payment after surplus between the purchase price and the actual appraised value. I want to see if anyone's had that come up recently, if it's kind of ruined any deals, or if you've seen the appraised value come up a little short from your purchase price. Has anyone run into that recently? Okay, so everyone's appraised value is coming at purchase price recently. Okay, so we have actually seen sometimes right now, especially with how competitive it is, that the offer or accepted offer tends to be much higher than the actual appraised value. And this can be a number of things, whether it's comps in the area not supporting that new purchase price, or just a buyer who has just been frustrated with how many offers they haven't gotten accepted, so they just went all in on this property and the value might not be there. So the way that works with the lending side is our loan is based on the appraised value, not on the purchase price. Typically, and before this current kind of crazy market, those tend to match up. But now in a scenario like $1 million purchase and the appraised value comes in at 900,000, we have to base our loan amount and write up off of the 900,000. So if they were originally doing 20% down on $1 million purchase, we would have to change that to 20% or however well qualified they could be on the $900,000 appraised value, and they would have to fund the additional gap. So right now we're seeing that as a big problem, especially with offers going in with either no loan contingency or no appraisal contingency. And the way you can kind of combat that or eliminate any risk of that is to make sure that your borrowers do have the assets to cover a shortfall. Now, we can get an appraisal and loan approved within about 12 days. So it's important to still have an inspection contingency and make sure that gives you enough time to inspect the property, get the property appraised, and let the lender do their job so we can give as much information to you and the buyer as possible. I want to stop and see if anyone has questions about that. So no questions so far. All right, so Raz has a question. The impacts, so here's a question on the impact of upcoming inflation on the markets. So right now, as of today, the Fed announced that they will be increasing their interest rates moving forward. It's not today that they'll be increasing it, but sooner rather than later. Just because of coronavirus and quantitative easing, the Fed has kept rates very low for the last several years. And so that's why mortgage rates have been so low. Right now, with inflation increasing, a strong hedge against that would be actually purchasing a property. So it's a good way to combat that. But right now, because there is so much liquidity out there and so much opportunity to lend, no one's making money. The only place for interest rates to go is up. And as long as income does not increase with that, I'm sorry, Artin is going to touch on this for a second. Sorry, we're just having a technical issue. So with inflation increasing, the thing we need, at least on a buyer's perspective, is for income to increase along with that, because everything is getting more expensive. And as inflation increases, interest rates are going to go up with that as well. And so you can expect to see, I would say, more of a flattening out of purchase. From a personal view, I would see purchase prices more flattening out as interest rates increase. And so it's kind of anyone's guess at this point, because we've never seen an increase in value like this, like we have over the last 2 years. But you can expect buyers to be a little bit more vigilant on their purchase price as rates go up and just the normal cost of living increases. Does anyone have any questions on that, or kind of filling the gap with appraised value and purchase price? Now I'm going to address some things on jumbo loans, which are loans above the 822,375 limit, or 548,000 in lower cost of living areas. So jumbo loans they're more difficult to qualify for. There's a lot more rules that surround them because there's a lot more money involved. The rules are a little bit more difficult for business owners as well, where they have more difficulty qualifying for these. And also, there's something called the reserve requirements increase with these large loans. Reserves are basically, excess funds that you aren't using towards your down payment. So something like your retirement assets can be used as reserves, but because a lot of these retirement assets are pre-tax, we can only use a percentage of these assets. So let's say someone has $100,000 in their 401k, we can use about 60% of those, so it would count towards 60,000. A lot of times with the different loan programs, it's typical to have reserves at about 12 months. So let's say they're all in mortgage payment, including insurance and taxes, is $6,000. So with that, with a 12-month reserve requirement, we would need $72,000 of reserves. So part of that can be cash, part of that could be 401k, retirement assets, brokerage assets, whatever could be liquid. With additional loan programs, the better the rates, the more difficult it is to qualify. So different banks have guidelines that state 18 months or 24 months, but typical right now is 12 months. I want to stop and ask if anyone has any questions on reserves. Okay. Now, because not everyone can qualify for jumbo loans, there's ways to structure purchases that may be, in the $1 million range, without the use of the jumbo loan. So the way we would do that would be to have a strong income level support the loan balances. Now, the majority of underwriting and lending is based on the income of the borrower. So if they're a strong borrower with a lot of income, but they don't have a lot of assets to put down or requirement for jumbos, it can be structured as a larger conforming loan balance of like 822,000 plus a home equity line to help carry and fund that missing gap. So let's say there's a purchase price of 1.2 million and they have $200,000 down, but they don't qualify for a jumbo loan. So as long as they meet the debt to income ratios of the first loan, including the home equity loan, which we would structure to fill the gap of 822 plus a home equity line fully dispersed at 180,000 to get us to $1 million plus their down payment. Then we can use that to push us across the line and purchase the property. I want to stop. That's kind of a complex scenario. It's not very typical, but I want to stop and see if anyone has questions on that.
Hi, Brett. This is Peter. Like myself, I retired and I don't have income. I do have asset. How do you calculate on those? And what I consider as your liquid asset or whatever you consider?
Sure. Thanks for the question, Peter. So retired people's, it is a different type of way to underwrite. So a lot of retired people either, not everyone has a pension, but most retired people have Social Security income, that income can be used to qualify for a loan. Also, if they have, if you are of retirement age, let's say you have a 401k or an IRA, if it has a significant amount of money, we can use distributions for that as income. It's the main qualifying calculation would be whatever the balance of their retirement asset is divided by 36, because loans are based on the ability to repay for 3 years. So just in this basic scenario, let's say you have $100,000 in an IRA. We could use distributions for that of 100,000 divided by 36, or about $2,800 to help qualify for the loan. So it's a way for retired people to use their assets to show income. It doesn't work the same way as cash. So cash or a brokerage account. So if you are in that scenario, you can do what's called an asset-based loan or stated income loan. These tend to be less documented and higher interest rates. It's more for these kind of scenarios, which typical lenders and banks don't like to do because it's a riskier loan. Does that make sense with the distributions from retirement assets or additional assets?
Could you repeat it? 36 and divide?
Yeah, so a loan, to qualify for a loan, they basically want to show that you have the ability to repay or that income is going to come in for 3 years. So that's their main basis to cover themselves. So if you have X amount in your 401k, you can we can calculate and take distributions for that total divided by 36. So at $100,000 in your 401k, and we started taking distributions, we could divide that total amount by 36 and come up with about $2,800 of monthly income to help support the loan.
Thank you.
Sure. Does anyone else have questions on retirement assets or ways for retired people to obtain a loan? Um, all right, and so now a lot of realtors are working with younger buyers or millennials, and typically with millennials, they are kind of riddled with student debt. And a lot of them make really strong incomes, but because of their student debt, their debt to income ratios are not too great. So with borrowers, especially ones in these scenarios, they these loans are a little bit more risky, but it's very typical of young people to have a cosigner. So basically, these rates are a little bit higher, but it helps, someone with a strong income that on paper does not look great, but can support a property. Also, the use of gift funds from parents and family members is a very common practice right now. It's not easy for people to come up with, the old school standard of 20% down for a down payment plus closing costs, especially in a market like ours where, the average home price is like 800,000. So with 20% down and closing costs, we're talking $175,000 in cash. It's not very easy for single or young people or, people with families. So the use of gift funds is very common. And as long as they are a family member, we can utilize cash gifts like that. I want to stop and see if anyone has questions about that or if you've run into scenarios like that. Okay. Well, that is my basics on loans and kind of what you guys should be looking for. I think the main thing when you guys are, working with new buyers is to kind of vet them yourself. You really can't tell a lot about someone until you get the documentation in front of you and a credit report. And so obviously that's not your job, but that's where we can come in hand and help you to not waste your time, because a lot of people will state one thing and then in reality they cannot back it up. And so it's important for you to make sure that your buyers are pre-approved, pre-qualified. You aren't searching in areas that they cannot afford, and you want to make sure that you're not wasting your time, wasting their time, or the listing agent's time. Because at the end of the day, real estate, it's a really small world, and the relationships you build with deals or falling apart deals can make or break you in the long run. I want to see, if you guys have had any recent purchases or sales recently, had any questions about that process or anything that might have come up that I can kind of shed some light on.
I kind of missed the earlier part, but what is the debt to income ratio usually?
Sure. So the debt to income ratio is basically any liabilities against the borrower to their gross income. So let's say they have a car payment, $500 a month. That's $500 in the debt category. And let's say they make $10,000 a month in the gross. So that ratio right there, it's about 5%. So if you add on any additional credit card bills, student loans, anything like that that might come up on their credit report, then that percentage increases. And the maximum debt to income ratio for most loans is about 50%. So what you would do, that's not part of your job, but it is good information to know. So on that, in a basic calculation, you would take their debts, like their car payment, plus the principal, interest, taxes, and insurance, the all-in payment for the purchase, divided by their gross income to come up with that percentage. So that's the way we as lenders, drop the amount. So let's say, with the $500 in this scenario, with $500 in debt payments, with a $10,000 gross income, we would have roughly like a maximum of $4,500 to play with on the principal, interest, taxes, and insurance side. Ideally, we would want to be under that percentage just to make things easier. But that's a good rule of thumb. And an easy way to kind of look up what an all-in payment would be. Zillow has calculators, Redfin has calculators, and you can kind of play around with the down payment amount. And it's not going to be 100% accurate, but it's about 80% accurate to give you a good idea. Does that make sense as far as the debt to income?
Yeah. So 50% as the maximum in general.
Maximum all in debt. So everything that they have, any lease payments, car payments, student loans, credit cards, that monthly payment plus the loan payment. And not that you guys deal with this, but as a resource for your clients, refinances are typically a little bit lower of a debt to income ratio. It's not by much, it's right around 43%, but it's something to keep in mind on a personal level, and just, being, a resource to your clients to point them in the right direction or give them an idea.
So again, the refinance, the debt to income ratio is lower than
A
purchase.
little bit lower. And then also with that, refinance rates are slightly higher than purchase rates. Just because those come in, it's a different market for those. Typically when interest rates drop is when you see a lot of refinances. But banks like to focus on purchases because purchases are kind of all the time. People are constantly changing properties, selling properties, buying properties. And so it's important for them to entice people to purchase and get that purchase business going. Whereas refis will dry up if rates skyrocket, where purchases will kind of never stop. Also, if you are pulling cash out of your property in what's called a cash out refinance, those rates are higher than just a standard rate and term refi. I'm going to stop and see if anyone has questions on that, just because those two concepts are a little bit different. Okay. And then, I just want to take some general questions. See if there's anything you're looking for as far as like a partnership with a lender, or any questions on a personal or client base that I can help answer. Okay, I'm gonna send my contact information to the group chat in case you guys come up with something or just have any specific questions. You can always email me, text me, call me to kind of chat through it, see if I can help you, or see if you can be, a better resource to your clients. Okay, with that, unless anyone has any additional questions, I think we can wrap up from here. Thank you all for your time. Feel free to reach out if you guys need anything or have any questions.